it true as our guide. With clarity on the mic, bringing light to the fight. Together we're ready, shining bright. Behind the agenda, plans in our hands. Exploring the progress where every voice stands. From the ground impact to the oil and gas scene. Together we'll build a future strong and keen. We'll dive into the data, the numbers don't lie. Examining the challenges, reaching for the sky. Education, infrastructure, let's pave the way. With fiscal responsibility, we'll seize the day. Behind the agenda, plans in our hands. Exploring the progress where every voice stands. From the ground impact to the oil and gas scene. Together we'll build a future strong and keen. Whoa, tune in every Wednesday, feel the vibe. For the stories and insights that we all prescribe. Plans, policies and programs we'll uncover. With every discussion, let's support one another. Behind the agenda, plans in our hands. Exploring the progress where every voice stands. From the ground impact to the oil and gas scene. Together we'll build a future strong and keen. We'll dive into the data, the numbers don't lie. Examining the challenges, reaching for the sky. Education, infrastructure, let's pave the way. With fiscal responsibility, we'll seize the day. Behind the agenda, plans in our hands. Plans in our hands. Progress where every voice stands. In the progress, from the ground impact to the oil and gas scene. Oil and gas scene, and we'll build a future strong and keen. Strong and keen. Tune in every Wednesday. Feel the vibe of team. Stories and insights that we all prescribe. Plans, policies and progress. Time to end discussion. Let's support one another.
Good evening and welcome to another episode of Behind the Agenda, Plans, Policies, and Progress. I'm your host, Cordell Jones, and welcome again. Thanks to all the persons who continue to tune in and share the live. If you can't catch us live, ensure that you catch the rebroadcast as we touch on very vital topics to give you a look behind the scenes to give you a better understanding. So tonight, we have a lot to unpack as we take a deep dive into the economic landscape, the management of our oil, or natural resources, I should say, and the political maneuvering that is shaping the national discourse. Now, the opposition continues to push the narrative that the government is over-borrowing to finance its development agenda. But how much truth is there to this claim? Is Guyana truly over-leveraged, or is this a simple strategic use of financial instruments to fund large-scale infrastructure and social development projects? And in a country experiencing some of the fastest economic growth rates in the world, how do we measure responsible debt management versus reckless borrowing? And then let's talk oil prices, the backbone of our current economic boom. What happens if oil prices drop? How well is Guyana positioned to weather an oil price crash? And what safeguards are in place to ensure continued sustainability and growth? Now, speaking of finances, an opposition-aligned representative has filed a legal challenge against the government's use of the Natural Resources Fund funds. What's the motivation behind this move? What is the lawsuit really aiming to achieve? And how does this tie into the broader political agenda? Finally, we'll break down the amended withdrawal rule of the NRF and what it means for Guyana's financial future, and how does it compare to international best practices in relation to sovereign wealth fund management. All this and more tonight as we go behind the agenda. So let's get started by welcoming Guyanese financial analyst, uh, our very own Joel Bagwardin. Joel, good evening. Welcome to the program.
Good evening, Cordell. Good evening to your viewers.
Now, Joel, before I jump in to the topics we want to discuss tonight, I want to ask you something that to give clarity to persons out there. Now, earlier this week, or I think it was last week, a video surfaced of a popular social media influencer claiming that these checks that persons are receiving now, in terms of the cash grant, they would only be valid for 3 days. Somebody who understands the financial system, could you give some clarity to those who may have doubt or may believe this person that if they don't cash their checks in 3 days, it's not valid anymore?
No, that's not true. A check generally is valid for 6 months.
Mm.
Any type of check, right?
Right.
And even even if the 6 months expired, the banks, the financial institutions, some of them may honor such a check.
Mm.
So the validity generally and strictly speaking of any check is 6 months. But if a check is still dated for more than 6 months, the person presents it to be encashed at a financial institution. The bank could either request that the check be replaced or the date change and the signatory sign to that,
Right.
or depending on the type of check and particularly the issue of the check, more so the issuer, with in terms of whose account the check is drawn on,
Mm.
the banks are likely to honor even a stale dated check. And
Right.
I can tell you, I've as someone who work in the banking industry, both in at the commercial banking level as well as the regulator, Bank of Guyana checks issued, any check issued by Bank of Guyana, which the Bank of Guyana is the banker of the government. So checks issued on a Bank of Guyana account is ultimately a government account or a government check.
Right.
As those types of checks, the banks tend to treat them as gold, so
Right.
to speak. So it's even if you have a stale dated check, a bank may, doesn't have to, but it may honor a stale dated check
Yeah.
in exceptional cases. So that the 3 days thing, it's not credible.
Right. Thank you for bringing some clarity on that. Now, on to our discussion this evening. Now, let's look at the macroeconomic fundamentals. Um, the opposition often argues that we're over borrowing. Talk to us a bit about that, and give us some clarity on probably some of the mechanisms or the instruments the government may be using that they may not understand, um, to probably fund these projects that we were talking about earlier, these infrastructure and social development projects.
Thank you. That, you see, Cordell, the idea that we are overborrowing, or another version of that idea, or another variation of the same idea, is that we shouldn't be borrowing at all, which we addressed briefly last week,
Mm.
because of oil resources, is is a misconception for many reasons. And some of it we dealt with last week, and this week I want to go into more or less a deep dive and deal with some other in a broader sense. But let's take a household example.
Mm.
Let's take a household example. You are managing a household and you may have accumulated savings. Now, the savings that you've accumulated in a bank account, is your earnings that you would have worked hard for over the years that you have accumulated. Now, you can either choose to, if you want to make a major investment in, say, building a house. Let's say you want to purchase a house or build a house and you've accumulated savings. Depending on how much you've accumulated, you could opt, you could decide, listen, I'm going to take all my savings. I don't need a bank loan. I'll take all my savings and build my house.
Mm.
But when you do that, you have a house which becomes your asset that is worth something, that has a market value, but your savings is empty. You have no cash. You got to work to accumulate again. So, what do you do? Do you take all of your savings that you've accumulated for over a number of years and put all of it in building a house? Or do you use some of it as equity to get your house going? You save some in your bank account, and then based on your earnings,
Right.
you apply for a loan, and that's how you finance your house. Most people do that. Most people, they do not deplete their savings. They use some of their earnings to acquire the land, build their foundation, and then they borrow the rest to complete the house.
Right.
When you financing a company, companies do the same thing. If you look at some of the largest companies in this country, for example, take if you look at DDL or Banks DIH, and you take a look at their financial position, their balance sheet, you'd see that the balance sheet is quite healthy. Should those companies borrow money or should they just deplete all the cash resources they have to finance their investment? No. So it is always a mixture when you're financing it, in financing, whether it is at a national level, whether it is at your household level, or
Mm.
whether it is at a company level. It is always prudent to have a mixture of financing. A mixture meaning some of it is made up of equity, which is from your accumulated savings, and some of it through borrowing or debt financing. And
Right.
that is how you have an optimum mixture, one that is manageable, a mixture that is manageable, and a mixture that does not expose you to a too much to a high level of default risk. So you want your mixture of debt to be as low as possible, right? You use a term in your introduction, over leverage. So you don't
Mm.
want to be over leveraged. You want to be moderately leveraged or under leverage, right?
Understood.
So under leverage and over leverage, we can get a little bit more technical. And in a technical argument, if you're under leverage, that's not good. If you're over leveraged, that is not good. You want to be somewhere in the middle.
Right.
Okay?
Right.
So this is the basic. I'm giving you the basic concepts, right? At a very basic fundamental level. Now, having said that, if you look at our debt sustainability indicators, I think if we look at it in a global context, before we get to our debt sustainability indicators, to give you global context, the global debt to global GDP. Now, global GDP is about $100 trillion,
Okay.
over 100 trillion US dollars. This is as of 2023 figures I'm quoting,
Okay.
right? Global GDP is about 100 trillion US dollars. And that global GDP, we're talking um, about 200 countries, or maybe just over 200. So The global debt to global GDP ratio is 235%. 235%. That means the total debt in the world is more than twice the size of the world's GDP.
Oh, wow.
Twice the size. And this global GDP that we're talking about, this is not only public debt, this is both public debt as well as private debt. So that
Okay.
is all the debt. That is private debt include household debt and and private sector debt include household debt and companies, firms at the firm level. So private sector debt together with public sector debt is 235% of global GDP, more than twice the size of the world's GDP. Now, that is a global context. Now, let's look at our context. Our total debt, and I'm talking about here now public sector debt, which is the government's debt, sovereign debt, plus private sector debt. And private sector here include household debt and farm companies. Our total debt to GDP ratio is 35%, a fraction of our GDP.
Wow.
Fraction of our GDP. Globally, the same metric, total debt to GDP, globally, it's more than twice the size of GDP. In our case, it is a fraction of our GDP. So that's the first thing in terms of giving context and giving a little bit of global context.
Mm.
Now, what are the key debt sustainability indicators? There are certain indicators. So the debt to GDP is one indicator, and that is well below the high risk. Now, when you look at risk, in risk management, there are different methodologies and different types of risk weightings and how you assess that. Now, generally, there are three levels of risk, right? In broadly speaking, when we're looking at risk management framework, or when we're assessing the risk profile of anything, whether it's debt, whether it is environmental risk, social risk, political risk, financial risk, any type of risk. There are three levels of risk: high, moderate, or medium, or another word used interchangeably for moderate or medium is modest, right? So
Okay.
simplicity, let's say moderate. So high risk, moderate risk, or medium, and low risk. Those three categories, that's that's the different levels of risk when you're doing a risk assessment. Now, from your debt to GDP ratio, a ratio of above 70%, above 70% is high risk. Above 70%. So if you are over 70%, you are considered high risk. So countries with 75%, 80%, 90%. In some cases, even 70% is considered moderate. In some cases, it depends on the country specific factors.
Right.
So in our case, given our current fundamentals, if we have a debt to GDP of 70%, I would say that is moderate. So let me reframe that. I would categorize maybe above 80%, above 80, 85, 90, 100, over 100 to be high risk. Moderate would be anything below 80% up to maybe 60, 65%. 60 to maybe 40% moderate. On the for on the 40%, on the 40% now, you're getting into your 30s,
Right.
low risk, right? That's how we look at it. On the 40%, you're low risk. Now our total debt, which is private sector plus public sector, is 35%. The total debt of the country is 35% of GDP. We're low risk. We're not even in the middle,
Right.
not even moderate. We're low, we're below moderate. Now, if you take out private sector debt and you only look at public sector debt, you're under 30. That's lower risk now. It's about 27% of GDP.
Right.
Now, if you take out the domestic debt, so public debt is made up of domestic borrowings from the financial sector as well as external borrowings, foreign currency denominated debt from the multilaterals and China and Exim Bank, etc. So the external debt is about 3.6 billion US. So that's obviously your external debt is less than let me see, it's about 18% of GDP. 80%. This year GDP might be somewhere about 30 billion. It's about 12% of GDP.
Mm.
Your external debt is less than 15% of GDP, and your total debt, external plus domestic debt, is less than 30% of GDP, maybe 27% of GDP.
Right.
So we're not even in the medium risk category, much less the high risk category. So the term that you use, over leverage, that is not correct. We're not in that range.
Right.
We're not in that range. In fact, we're not on the leverage either. We're in the low risk, but we're not on the leverage either. We're not, if we come down lower, if we come down to maybe below 20%, then I would say we are on the leverage,
Right.
right? So that is one indicator. And then compare that to where we came from historically when we were bankrupt. We were 900%. That means your debt just about 30 years ago was 9 times the size of our GDP. Today it's a fraction of our GDP. A fraction of our GDP.
Yeah.
0.27. 0.27. We're a fraction of GDP. Now, another indicator you want to look at is debt service.
Mm.
A debt service to revenue ratio. Now, what is your debt service to revenue ratio? Your debt service to revenue ratio is your total debt repayment, which would include blended payments of principal and interest. What is your annual debt repayment? That is your debt service.
Right.
How much revenue we're using to service our debt. And it's less than 10%. It's about 6% of our revenue. And we're talking about non-oil revenue here, you know.
Right.
I didn't add oil revenue. We're talking about non-oil revenue. It's about 6% of our non-oil revenue that we're using to service our debt. Now, what is a good benchmark? Now, on an individual level, when you go to the bank for a loan, the bank would look at these same indicators, but on a personal financing level, right? So the GDP in a per in the case of a household would be the value of your asset, the total value of your asset that you're using to collateralize the loan. That we could use that to replace GDP in a personal level or a
Okay.
household level, right? And the bank would look at what value, what is the value of loan or what is the amount you're looking to borrow, and they would look to determine your eligibility, to determine your credit worthiness and eligibility for a loan. They would look at that amount you're asking for as a relative percentage of the value of your asset. Now we're replacing GDP. GDP here means asset too, The GDP, we can interpret that to mean the total value of asset of the country in terms of productive output, in terms of the value of output.
Right, right.
On a household level, your GDP is the total value of your asset. And the banks use what is called a loan to value ratio. And they have a benchmark that guides them, which is about 70% maximum, meaning the banks would not lend you more than 70% of the value of your asset. In other words, if you're going for a loan that is greater, the value of the loan is greater than the value of your asset, you will be in a you will you're creating a recipe for bankruptcy. And the
Mm.
bank would not lend you in any case. The bank would never lend you an amount of money, a loan amount that is greater than the value of your asset. So they look at your loan to value ratio and it should be about not not higher than 70%. So your loan to value ratio is the same as your debt to GDP ratio. Okay? Your
Right.
loan to value ratio in a household example is the same as your debt to GDP ratio at a national level. And maximum 70%. So anybody you have a loan and use what looking viewing this program, you calculate what is the value of your loan, the outstanding balance of your loan, and what is the percentage of the value of your asset. That's your loan to value ratio. That's like your debt to GDP ratio, right?
Understood.
Then the second thing the bank would look at is your repayment capacity. Now they have to assess your repayment capacity to determine to help them to determine the credit worthiness, your credit worthiness as the borrower. And they would look at, they may not tell you this, banks don't necessarily tell you all, they don't educate you. That's not their job to educate you, right? Their job is to ask you for a bunch of information. They do their analysis, and either you get a few weeks down the line, a few weeks down the road, you either get a phone call that your loan is denied or it's approved. And you
Mm.
have no idea if your loan is denied, why it's denied. They won't go into the analysis with you. But I'm walking you through the analysis. I'm giving you the case of a household and the same how it's done. It's the same principle on a national level. So your repayment on a household level in a personal capacity, your loan repayment must not exceed 30% of your income. So if your repayment, principal plus interest, is 30% or less of your income, then that's another good indicator that would help to qualify you for the loan. The same thing on a national level. On a national level, this is the benchmark that we use. You don't want your debt repayment to be greater than 30% of your revenue. And I've already established that on a national level, the total debt repayment of our debt is 6% of non-oil revenue. 6% of non-oil revenue, way below 30%. The
Mm.
same thing will happen when an individual goes to the bank for a loan. Your debt repayment should not be greater than 30% of your income. If your debt repayment is greater than 30% of your income, then your loan will be denied. It means that you do not have the repayment capacity to service the loan in the long term.
Right.
So that's the second indicator. The third indicator is looking at our external borrowings, that component of it now alone. Now, to service your external debt, you can't service that with the domestic currency. You got to service that with foreign currency. Where do we get the foreign currency from? Now, we have to earn it. We have to earn it through exports as well as other sources that we earn foreign currency from, or other sources that generate foreign currency inflows would be foreign direct investment, remittances, uh, return on investments abroad, gains on foreign exchange trade, etc., and several other sources of inflows. But the main source of foreign currency inflow is your export earnings.
Right.
And so now to determine your external debt repayment capacity, that has to be anchored on the strength of your foreign exchange earning capacity as well as your foreign reserve level, the level of the country's foreign reserve. And when you look at the total foreign sector, net foreign sector assets and reserve in the financial sector, we have almost 1.3 times the size of our external debt. That means we have enough foreign foreign reserves, foreign exchange reserves, and net assets to clear off entirely, to pay off entirely our external debt. Now that is a good position to be in. If our reserve was far less than the size of our external borrowing, and our export, our foreign exchange earning capacity vis-a-vis exports was weak, then that would signal trouble.
Mm.
But that is not the case. Our export earning capacity is expanding in the non-oil sector as well as the oil sector, and our reserves are growing to the extent whereby our reserve is sufficient to pay off all of our external debt. So I've given you solid indicators, three solid indicators: debt to GDP, debt service in repayment capacity to revenue, debt service to revenue ratio, and we've looked at our external debt indicators in terms of our reserve and foreign exchange earnings.
Right. No.
And then and then I situate all of that within a global context. So with all of that, the question of whether we're overborrowing or whether we're over leveraged or whether there is reckless borrowing, from all these indicators have empirically disproven such notion or such idea.
Mm.
That is not the case. And I like, I was listening to the song that you've created for this program, and you use a term in there in the lyrics fiscal responsibility.
Mm.
That these indicators that I've just walked you through, that's what you call fiscal responsibility. It is within that framework that we refer to as fiscally responsible.
No, I'm thinking this information you just shared with us, these indicators you'd have given as well. This is available all over the place, or at least these persons making or putting forward their argument in the opposition should be aware. So again, I'm asking you, where do you think this argument comes from in terms of Guyana's overborrowing? You think it's just trying to confuse persons who may not have the kind of financial knowledge about these kinds of things?
I think it's a combination of factors. I think the political motivation in that regard is there in terms of the opposition trying to create a certain narrative and a certain view that is far removed from the realities and the facts. But that is compounded also, that is compounded by the fact that they're clueless when it
Mm,
comes to the technical arguments and the technical analysis.
right.
Because if you listen to the other side and when they talk about debt to GDP, they, their interpretation of debt to GDP and what it means, when you listen to them, they haven't a clue what they're talking about. They haven't a clue what they're talking about. But
Mm,
they're very skillful in displaying that level of ignorance sometimes, which is convenient for their political objective.
yeah, yeah, I
Right?
agree.
The other thing that I want to add, there's another important element is that is whether oil price, because the argument that they make, one of the argument that they try to use to substantiate what they're saying is that we are borrowing against future oil revenue.
Mm. Yeah, I was coming to that. And oil price volatility and that kind of thing.
Right,
So what happens in the future if oil prices go below the threshold?
right. So first, let's examine whether we are borrowing against future revenue.
Mm,
Now, certainly, the expansion of the economy and with the multiplier effect, I don't want to use the words uh, spin off or knock on effect or spillover. It's not really a spillover, it's a multiplier effect, which is a totally different concept. A multiplier effect is very different from a spillover concept. So, the multiplier, as a result of the multiplier effect, which is underpinned by deliberate policies by the government, administration of deliberate policies, expansionary policies, as well as strategic investment in the non oil economy.
mm,
The oil economy is certainly driving that, and that is a given. To what extent it is driving that is a case for a debate. To what extent? Because, on the other hand, as in the case of the APNO EFC, their style of economic management, if we were to, in theory, ramp up production, oil production, the multiplier effect of that on the non, in their case, you would have had spillover, not a
mm,
multiplier. In their case, with their style of management, it would not have been a case of the multiplier effect leading to the expansion of the non-oil economy that has resulted in our non-oil revenue still being greater than the oil revenue. 38% of the budget is financed from non-oil revenue, whereas oil revenue only accounts for 33% in this year's budget.
Mm.
That is indicative of the expansion in the non-oil economy, indicative of the multiplier effect that I'm talking about, driven by the oil economy, and that is a given. But I'm also making an argument to demonstrate for the viewers' benefit to understand if you were to have the APNU style of management, economic management, and you had the same level of activity in the oil and gas sector, the multiplier effect would have shrunk. And in fact, you would not have had, technically, I wouldn't call it a multiplier effect. You would have spillover. So let me give you an idea what that would look like. First of all, we would not have had local content. They would not have passed the local content law. And we fought for this. When they were in government, we fought. And I was part of that fight at the private sector level.
Right.
Three drafts of a so-called policy, and all of it were worthless. All three versions were worthless. So they were never going to implement the local content law, which means Guyanese businesses and on an individual level in terms of employment would have been deprived of over 700 million US dollars in opportunities. So that 700 million US dollars in opportunities would have gone to another shore,
Right.
another country. That would have been a loss. Then on the capital side of the budget, that would have remained shrinking, maybe flat, and consumption would have gone up. They will consume more, and so you would not have had expansion in your non-oil economy.
Mm.
And so we would have become, in that scenario, our economy would have been heavily dependent on the oil resources. The oil resources would have accounted for a greater percentage, a greater portion of the budget. And non-oil revenue would have been shrinking. And that would have been a recipe for disaster.
Mm.
Fortunately, our non-oil revenue and non-oil economy is greater than the oil resources that we're using to finance the budget. Greater than that. And that is indicative of deliberate policies and investment in diversifying the economy and expanding the non-oil sectors. So with that said, now let's now come to oil prices.
Right.
Actually, before I get to oil prices, is it true now, having said it, is there any merit in the notion that we're borrowing against future oil revenue? The short answer is no. How or why? Because as I've established earlier, our debt repayment is less than 10% of non-oil revenue. So we are servicing our debt from non-oil revenue, not oil revenue.
The traditional
If,
sectors.
if our debt repayment was greater than non-oil revenue, and you now had to tap into oil revenue to service debt, then there would have been merit in the notion that we're borrowing against future oil revenue. But empirically, that is not the case. Our debt service is financed from non-oil revenue, and it's less than 10% of our non-oil revenue.
Understood.
So I'm empirically establishing my argument, I'm not going through speculation and conjectures and making things up. Empirically, and anybody could go and do this and verify. Let's now come to the oil price.
Right.
What happens if oil price falls below a certain level? Now it will certainly have a negative impact in our case in terms of a loss of revenue. In terms of loss of revenue. But the question is, will we be able to withstand such an impact?
Mm.
And more importantly, the most important question, if oil price loss of revenue is one thing, but will we still be making money? Will our oil still be lucrative, still be attractive, still be profitable? Because a percentage loss in revenue, right? A percentage loss of revenue is better than 100% loss. A percentage, whether 20%, 30%, 40%, 50%, 60%, that is better to live with than 100%, right? And so that is what we want to determine. What will it be? So here are some important factors to bear in mind. The first is that our crude is one of the better quality, in one of the best qualities rather, one of the best quality crude globally speaking.
Right.
It's a light crude, sweet crude, which carries a premium price on the market. So for example, Venezuela, right next door to us, they have the heavy sour crude. So when crude is trading, if you Google now what is Brent crude price, you might see maybe $80 or $75. They're not getting $75 for their crude. They might get about $50 or $60. They have to blend it.
Mm.
They have to blend it with the lighter crude to sell it. So we are not in that situation. We have a light, we don't have to blend our crude. We have the light sweet crude. So we get the best price in the market. We get the best price in the market. The highest price in the market. Other countries can't say the same. Our neighbor next door can't say the same. So that's the first thing. The second factor is, what is the break-even cost of our crude, of our Stabroek block? Because that's the only block in production right now. And where does that break-even cost, how does that break-even cost compare globally? Our break-even cost for the Stabroek block as of right now is $22. 22 US dollars. And that came down from an average of $46. $46. Okay?
Mm.
So our break-even cost has fallen to produce a barrel of crude. It was averaging 30. Now it has come down lower to less than $30. $22. And this is as of 2023. Later this year, in April, when the oil companies file their financial statements with the with the deeds registry when they file their financial statements, and I get copies of those. I'll work back the numbers to see where it is in 2024. But
Right.
data that I have right now, which is 2023 data, it's $22. Globally, globally, the global average is $35. The global average break-even cost is $35. Now, you have about 68 countries. You have about 68 countries whose break-even cost is higher than $35.
Mm.
Higher than $35. So that means in the future, in fact, let me go through, let me give you a summary of my analysis, right? Bear in mind, we're talking about 68 countries, 69 if you add Guyana.
Right.
And these 69 countries, including Guyana, account for nearly 50% of global output. Nearly 50% of global output. Now, here's the summary of my analysis. And this is a sensitivity analysis which I did recently. If oil price falls below $80 to $65, 5.1% of global output will be negatively impacted. Now let me explain here what I mean by negatively impacted. And let me draw the distinction, what it
Mm.
means to Guyana. Negatively impacted in Guyana's case has a different meaning to what it means to when I use this term globally. Negatively impacted in Guyana's case means we're only going to lose certain percentage of revenue. Our stable block will remain profitable. So negatively impacted in our case has a different meaning. In this case that I'm going through here, what I'm going through here, negatively impacted here means these countries, 5.1% and all the percentage that I'll go through, the percentage of impact, these are countries that account for this much global output that will go out of business.
Mm.
That if oil price fall to this level, their oil production will become unprofitable. Unprofitable. They'll go out of business. So let's go over this again. If oil price falls below $80 to $65, 5.1% of global output will be negatively impacted. In other words, become unprofitable to produce into the future and to develop. If oil price falls below $65 to $55, 18.5% of global output will be negatively impacted. If the price falls below $55 to $45, 22.9% of global output will be negatively impacted. If the price falls below $45 to $40, 36.8% of global output will be negatively impacted.
Wow.
The price falls below $40 to $39, 39.4% of global output will be negatively impacted. If the price falls below $39 to $33, 44.4% of global output will be negatively impacted. And if the price falls below $33 to $30, 47.1% of global output will be negatively impacted. So if oil price falls to
It's still good.
$30, 47% of global output will become unprofitable and we will still be profitable. Now, if you have a loss of nearly 50% of global output and the market still need that 50% that has been that has gone
Yeah.
out of business, that were lost. We still have an opportunity. There will still be demand for our crude, so we will remain profitable, and there
Right.
will still be demand for our crude into a long time into the foreseeable future. A long time into the foreseeable future. At $25, we will make a profit. At $30, we'll make a profit. At $22, we break even. And hear this: break even would fall even further. There's something in economics called economies of scale. And economies of scale means when you produce more for less, producing, being able to generate a higher output at a lower cost. And this is what has been happening in the Stabroek block.
Mm.
As production capacity increases, the cost of production falls. Because when you analyze your cost structure, you look at your financials, you have what is called fixed cost and variable cost. So fixed costs are those costs that would remain fixed, remain constant, despite your level of output. So your level of output could fall or increase, and your fixed cost remain fixed, remains constant.
Right.
Only a variable cost would vary depending on level of output. And so as we ramp up to over 1.3 million barrels per day and fixed costs is at a certain level, then you'll have greater economies of scale, then you have a lower break even. And I estimate that it will go below $20.
Mm.
So that is why it is important to ramp up production,
Right.
break even cost. And so if oil price come down to $30, $25, we still in the game. We still in the game.
Yeah. Now, Joel, I want to bring your attention over to an oppositional line representative who has filed a case against the government regarding the use of the NRF funds. Talk to us a little bit about what he's seeking to achieve here based on your understanding.
I I love to get into the details of that, but I see we are almost out of time.
Yeah, indeed, indeed,
So
indeed.
I think we should leave that one for next week. But
Mm.
I'll let me share a little secret with you and the viewers, of course. And the little secret is, you know exactly what he did. I was contemplating to do, but not to sue the state,
Mm.
not to bring a case against the state and sue the state for anything. I was contemplating after I saw this guy. Now you recall I dealt with this issue when he bring up this thing about NRF, the government in violation of Section 16 of the NRF
Right.
and so on. I dealt with it, and I think I dealt with it comprehensively. The vice president dealt with it, and I think he dealt with it comprehensively. And then the finance minister dealt with it, and he dealt with it comprehensively. And the guy still hold on, and I said to myself, you know, they're trying to create this narrative, hold on to this thing, to say, to support, to sort of, in a way, substantiate, but not credibly, to fallaciously substantiate their argument or their narrative that there is a lack of transparency and accountability in the use of the NRF funds.
Mm.
And so that is what I thought, what I think is their objective and what they're trying to do. And so I, about a week, I even spoke to an attorney about it. I spoke to a few I spoke to one attorney actually and asked them, listen, I'm thinking of going to court, file a case in my name, asking the court for an interpretation, not a court order or suing the state, just an interpretation of the law. Because this back and forth argument is only the court could rest the matter, put the matter to
Right.
rest.
Right.
So I was contemplating going to court for an interpretation of the act and the relevant section. So while I was contemplating the idea and even discussed it with an attorney, a very seasoned senior attorney. 2 days after the attorney sent me the Facebook post, Terrence Campbell filed somewhere. So, like the man read my mind or something, right? So he's going for some. He's taken a very different approach.
Right.
He's taken a different approach. He's going to sue,
Bye.
and in this case, he's asking for some specific court orders. So that might take up an entire program to get it all the details of that.
No,
So
but before we most likely deal with that next week. But before we go, just give us a little understanding of the amended withdrawal rules for the NRF.
let's deal with that as well, because that one is a little bit technical, and I want to take my time to explain it.
Okay, no
Right?
problem.
It's a little bit technical, and I want to take my time to explain it.
All right. Well, that's all the time we have for this show. Thank you guys for tuning in. On behalf of Joel and myself, I'd like to thank you guys for joining us. Please remember to share the live, whether you're tuning in on YouTube or Facebook, Joel's page, my page. Share the live so we could get the information out there. Some really good, I should say, a really good breakdown of some of these technical issues for some of us who could understand the layman explanations better. Thanks, Joel, for being here week after week to share with us. We'll be back here next Wednesday as usual. And thank you for staying with us on this episode of Behind the Agenda.
In the heart of our nation, where voices collide, we're breaking down the policies with truth as our guide. With clarity on the mic, bringing light to the fight. Together we're ready, shining bright. Behind the agenda, plans in our hands, exploring the progress where every voice stands. From the ground impact to the oil and gas scene, together we'll build a future strong and keen. We'll dive into the data, the numbers don't lie. Examining the challenges, reaching for the sky. Education, infrastructure, let's pave the way. With fiscal responsibility, we'll seize the day. Behind the agenda, plans in our hands, exploring the progress where every voice stands. From the ground impact to the oil and gas scene, together we'll build a future strong and keen. Whoa, tune in every Wednesday, feel the vibe. For the stories and insights that we all prescribe. Plans, policies, and progress we'll uncover. With every discussion, let's support one another. Behind the agenda, plans in our hands, exploring the progress where